Do you know what is repo rate or reverse repo rate? Should I explain it in technical terms or give you a simple answer? I'm just kidding. Watch the video until the end to know exactly what these two terms mean. In the realm of central banking and monetary policy, the repo rate and reverse repo rate are two vital tools employed by central banks to regulate the flow of money in the economy. These rates play a significant role in influencing short-term interest rates, controlling inflation, and maintaining overall economic stability. So let's see what repo rate and reverse repo rate are and how they function. Repo rate. The term repo stands for repurchase agreement. The repo rate therefore is the interest rate at which the central bank, like the Reserve Bank of India in India or the Federal Reserve in United States, lends money to commercial banks for a short period. This transaction involves a sale of government securities by the central bank to a commercial bank with an agreement to repurchase them at a predetermined future date. The difference between the sale and repurchase prices along with the duration determines the interest charge, which is the repo rate. The primary purpose of repo rate is to enable the central bank to influence the liquidity and interest rates in the banking system. When the central bank lowers the repo rate, borrowing becomes cheaper for commercial banks. This encourages banks to borrow more money from the central bank and subsequently lend more to individuals and businesses at lower interest rates. Lower interest rates stimulate economic activity and investment, thus promoting economic growth. On the other hand, when the central bank raises the repo rate, borrowing costs for commercial banks increases. This discourages excessive borrowing, controls inflation, and maintains overall economic stability. Now let's look at what reverse repo rate means. The reverse repo rate, as the name suggests, is the rate at which commercial banks park their surplus funds with the central bank. In this transaction, the central bank buys government securities from commercial banks with an agreement to sell them back at a later date, typically at a higher price. The difference between the purchase and sales prices along with the duration determines the interest earned, which is the reverse repo rate. The reverse repo rate acts as a tool for the central bank to absorb excess liquidity from the banking system. When the central bank increases the reverse repo rate, it becomes more attractive for commercial banks to deposit their surplus funds with the central bank rather than lending them out. This helps control inflation and prevents the economy from overheating by reducing the money supply. In summary, the repo rate and reverse repo rate are essential tools used by central banks to regulate the money supply, manage inflation, and control short-term interest rates. By adjusting these rates, central banks can influence the behavior of commercial banks and subsequently the broader economy. A delicate balance in setting these rates is crucial to achieving the central bank's goal of price stability, economic growth, and financial stability. Changes in these rates can have a significant impact on financial markets and, by extension, the daily lives of individuals and businesses. I hope you found this useful, and for more information on all financial curiosities, subscribe to our channel today.